Well, inflation data this week could indicate the Fed's next move with the rate hike likely in the cards. But the big question is not, of course, what's going to happen this week, but what's going to happen after that, and how best should you position your portfolio into the new year? Joining us now is our pal Steve Sosnick, Interactive Brokers Chief Strategist. Steve, it's good to see you. So how are you thinking about this week? How are you sort of framing this week, given that the Fed has been pretty clear about what they're doing this week? So how do you game out what happens next?
Good morning, Julie. Great to see you. The key with the Fed is more about the nuance than it is about the actual number right now. Yes, as you noted, everybody's looking at 50 basis points. They have been looking at 50 basis points for a while. The probability has been extraordinarily high of a 50 basis point move for some time, even before the most recent comments. The keys here to me are going to be A, the dot plot. I think the market may be anticipating a pivot or a pause that is quicker than the Fed may be looking to indicate, although there's not a ton of granularity in there. But we may be looking at a potentially higher peak rate. As you show on the chart, we're looking at about 5% right now is priced in by the market, just a little under. Let's see where that goes. A lot has to do with tone also. On November 30th, when Powell spoke to the Brookings Institution, a lot was made of, his speech. The market ripped higher. I think a lot of that had to do with end of month effects and some selective option buying, but a lot of it was, he's back to sort of this Goldilocks-ish tone. And I think the market liked hearing that. So there'll be a lot of nuance in the conference call, hopefully a lot of nuance in the conference call, and that's what people will be reacting to.
Steve, within that tone, the Fed chair has been reluctant to use the word recession, and you could see that in the transcripts by combing through those. And so do you think it is still time for the Fed to continue kind of easing away from using that word in whatever they're signaling and how they're communicating? Or is that an acknowledgement that they need to make for the sake of credibility, even knowing that that was one of the challenges that they were trying to reestablishing that credibility earlier on this year?
What they should do from a market point of view vis-a-vis what they should do from an owning up to a point of view may not be the same thing. If I were the Fed, I wouldn't use the term recession, because if there's a recession, guess who would be blamed for causing it? So that's really not, that's going to be outside their vocabulary. They're going to use, all the euphemisms, real risks, potential slowdown. And let's see if he reiterates whether or not the key will be fighting inflation at the risk of whatever euphemism you want to use, economic instability or economic malaise, whatever. I won't wordsmith his statement.
Steve, hit us with something that may go right economically to kick off next year.
Well, what may go right, I guess, would be the idea that the Fed could land the plane. Now, the problem here is I think that's becoming the base case, if not necessarily among economists, but among a lot of market participants. The bond market and the stock market definitely diverge. The bond market is telling us that, we're in for a much bumpier landing than the stock market thinks. Now, if the stock market's right, that's something that really could go right. That's a big positive, and then the bond market would have to retrace itself to a certain extent, but that would be a good thing. The problem is I do think that's a little bit priced in, and when the stock market and the bond market diverge, I tend to put my money where the bond market is. They're a little less distracted by things other than the economy and monetary policy.
That seems to be sort of in line with what we learned in this week's Bloomberg MLive Pulse survey, where they talked to different strategists, investors, et cetera, and they found retail investors are going long equities ahead of the Fed, and institutional or professional investors are shorting equities ahead of the Fed, which kind of is in line with what you're saying here.
We see that in our customer numbers too. We've seen customers continue to buy, to bargain hunt in a lot of their favorite names, many of which, among the ones that were on Jared's board a few minutes ago. But they can't be shorting it too aggressively, because we really have only dipped a relatively small amount since that speech. We've really just been testing the 100-day moving average on S&P. Which is where we bounced on Friday, we were sinking, and where we bounced this morning. So right now, I'm not going to say that they're necessarily aggressively shorting the market. Maybe the trading type accounts are. I would say a lot of the big institutions may be a bit underinvested, which is why you see these ferocious rallies Once one gets triggered, they just all nobody wants to miss it, and so you get that pile-on effect.
You wrote in a recent note that markets are now in recession mode, right? Like you sort of said, it's like cars that have different modes. What is it? Was it ludicrous mode that was one of the Teslas? I can't remember. So what does recession mode mean? Does it mean that even that market participants are more likely to read the tea leaves as negative, given that sort of lens through which they're looking at the news?
Yeah, and I wrote that very specifically because we had a few days where we had bond yields down and stocks down. So that to me is the market saying, "Oh, wait a minute, there might be something to this bond market weakness that's being shown." I don't know that we're fully there, but we've had certainly an outbreak of days where the recession mode has been in place. That's kind of your tell. You want to see, if you're betting on a stronger economy, you want to see stocks up and bond yields, up as well. But you don't want to see them both sort of down together, because that's not necessarily a great sign. Remember, if we're hoping for a quick pivot from the Fed, that pretty much implies that we're going to have some sort of economic weakness between now and whenever they pivot. That's really a careful what you wish for kind of thing for equity investors, because do you really want to be wishing for the type of economic slowdown that gets you the Fed relief that you're hoping for? We're in a very tricky situation as a result of that, because it's a very fine tightrope that we have to walk, and that's why you do see those days where the market just gets into that what I'm going to call recessionary funk.
Yeah, a slowing economy with rates still going higher, or a really slowing economy with them stopping raising rates. It's not a great decision. Steve, thanks so much for being here. Good to see you. Interactive Brokers Chief Strategist Steve Sosnick.